Paul Robinson is Global Head of Foreign Exchange Research at Barclays, joins us now. And so, Paul, let me then start by asking you about the ECB meeting set to take place today. We're not expecting any change to the interest rate. But nevertheless, we have ongoing risks here in the Eurozone, despite this relative calm in financial markets. So is this going to keep the euro under pressure as the year progresses?
Yes, I think it's going to be a really crucial issue for the euro. The bottom line is European growth is extremely weak. ECB policy is very accommodative. And therefore, cutting interest rates today would do very little, really. If you look at market rates, they're already very low. But I think what Draghi is going to tell us is that the ECB is still extremely concerned about prospects for the euro area economy, that loose monetary policy is not likely to change anytime soon. And that, to some extent, I think, contrasts with what the FOMC are slowly coming round to, and the more general picture of US economic health as opposed to European economic weakness.
Since you mentioned the FOMC, Paul, is the greenback, is the dollar a good buy right now at current levels against the euro?
Yes, I think it is. I think the dollar's a good buy, actually, against most of the majors, against sterling to a lesser extent than the euro, but also the yen. You know, as I said, we think the monetary policy is going to gradually move in the dollar's favour. But more importantly, just the economic fundamentals in the States look really quite significantly brighter than those in the euro area. Of course, the US has issues, but the US does appear to be dealing with those issues in a somewhat more straightforward and speedy way than is happening in Europe.
Talk to me about the decoupling between a weak euro and buoyant stock markets.
Yeah, so the euro has been pretty strongly correlated with global equities over the past couple of years. And I think there are two reasons for that. The first is that European issues have been a real problem for the global economy as a whole. So if European issues lessen somewhat, then that's good news for the euro, and at the same time it's good news for global equities and vice versa. The other point is that the key issue coming from the US has been, will the Fed loosen monetary policy? If they do, that will be good news for global risk. And the relationship between the Fed and markets has been primarily via risk appetite. We think that going forward, that's going to slowly change, so that the relationship between US data and Fed policy is going to be more straightforwardly positively correlated with dollar moves, and because it's going to be positively correlated with dollar moves, it will be negatively correlated with euro moves.
What about some analysts are talking about the possibility of the euro rising against the greenback because of trading patterns? Do you buy that?
Well, yeah, there is a possibility that the euro will appreciate against the dollar. I guess that the thing they've really got in mind is that the Asian economy is going to carry on growing more strongly. China, in particular, is going to be an engine of growth going forward, and that parts of the euro area, in particular Germany, have close relationship with China. Fine, but I'd say that's all in the price. There's nothing new here whatsoever. That you know, where is the news here? You know, we've known that China will be a driver of global growth for a number of years now. So I don't think, really, I think it matters for the level of euro-dollar, and it's one of the reasons why euro-dollar is still above 130. I don't think, though, it's going to change the likely course, which is for a move down. What
could the potential end of QE in the US mean for commodity currencies, including those linked to crude? Are they going to run out of steam?
I think it really is crucially dependent on why the US move towards tighter policy happens. If it's happening because higher inflation expectations, then that's, I think, very bad news for global risk appetite and probably for commodity prices. However, if it's happening because the US economy is growing and risks to the downside are lessening, and at the same time, while the Fed is talking slightly more hawkishly, it's still got a very loose monetary policy stance, which I think is going to be the case, then I think that's actually a reasonably good environment for commodities, for commodity currencies, and for emerging market currencies to do well in.
What about sterling? We've seen it dropping from its strongest level since November against the greenback on those comments from the British Chambers of Commerce, saying the economy still faces huge challenges and the recovery is much too slow. I mean, tell me, Paul, is the UK vulnerable to outflows? The fact that we're facing, well, risks from the Eurozone, but also a fiscal drag in our own country, is that going to encourage investors to perhaps shift funds abroad?
No, I don't think so, really. I mean, again, there's not too much news there. I think that the key thing for sterling relative to the dollar is what happens to euro-dollar, to be perfectly frank. The weaker euro-dollar is, I think the weaker cable will be. But sterling, to my mind, actually is likely to appreciate against the euro, appreciate against the Swiss franc as well. And really, for similar sorts of reasons to the dollar, which is that the economy is probably being addressed, or the economic issues are being addressed a bit more quickly. The fiscal position is much clearer in the UK, and actually talking to international investors, people are reasonably upbeat about prospects for sterling.
All right, so you expect an appreciation in sterling. I must ask you about the yen. Retreated what, more than 8% since reaching a post-war high of 75.35 in October. Where do we go from here? Are we going to get a stronger yen? I mean, certainly the Tankan survey revealed that executives see the Japanese currency possibly averaging 78.14 per dollar.
Yeah, we think the dollar-yen is going to go higher, so the yen is going to weaken a bit further. Several reasons for that. One is the dollar. You know, we shouldn't forget the dollar in all of this. People keep talking about dollar-yen as if it was just a Japanese phenomenon. It's not. Second issue, I think, is that for the first time for a long time in my memory, Japanese monetary policy looks like it will be able to actually weaken the yen and be potent. I think that's an important issue. Third factor is the general trend in the Japanese current account position and trade position has been pretty worrying. Now, everyone expected this to happen at some point over the next few years. The fact that it's happening so quickly, I think, has brought it into the market's focus, and that is a yen negative. So for all of these reasons, we think that the yen is likely to sell off a bit further, or at least relative to the dollar.
All right, thanks so much. Always good to get your analysis, Paul Robinson.
Thank you very much.
Global Head of Foreign Exchange Research, Barclays. Thank you very much.